WIBI.com. This is John's report. It's for the 12th of October. Well, no surprise, everybody is waiting on, the Fed to announce that they're going to, provide additional liquidity and or stop what they're doing to justify buying. And actually, we saw the first early signs of it. The Fed opened up credit swap lines for Switzerland, uh, minor amount, around 3 billion, but it's just starting to expose the dollar shortage that exists out there in the real world. And when they have to start making those kinds of transfers to various countries that otherwise normally you wouldn't be doing, you can see that there's some fractures taking place. And this was part of what we saw from the Bank of England having to intervene in their credit markets. We'll probably see the same thing happen within the Eurozone, and that because, again, when you can get U.S. Treasuries moving at much higher rates, why would you be buying ECB bonds? It's not even close. It makes no sense. So um, there's that reality, and we're seeing that play out in real time. But the market really needs is that perception that the Fed is going to slow down or stop, and but based on the numbers that come out, there hasn't been a justification for it. You see still, consumer debt rising and credit cards and 32%, about late on their credit card payments and that, but that hasn't caused any alarm at all. Interestingly enough, we did move based off the white MBI uh, lead up back down to that 0% the other day, which was within the expectation. Um, and after doing so, we got a further drop off, but there's been no recovery in magenta at all. And we do have some fading of the orange, so the potential for a reset and potentially higher pivot P2. And that would be significant because that would be a compressed double bottom. That could be a powerful potential move. And I'm sure a lot of people are going to be looking for that setup. But if they start down, they're jumping the gun just because you see two retests of the base does not mean that you have a buy signal. So, a lot of people get confused. I think just because something happened that automatically turns the situation to the opposite direction. No, you actually have to have actual real buyers to do things because chart patterns alone just don't justify that. It may create an impetus for people to do things, but until they actually do them, and then it's a question of who's doing them. Because if it's just regular lay people doing it, you might be able to move a GameStop or, Twitter stock individually with an aggregate number of people, but broader market, no, you have to have the big players involved, and uh, they do things a bit more methodically. So we're always keeping an eye out for those setups, and that's exactly what we're trying to watch for. But overall, we can still see weak shakeout, weak MBI readings, DOC. I wouldn't call it horrible. It's not great. I mean, minus 18 on the red DOC, but we're in a potential pivot zone turnaround with that orange dip. You got short-term buyers popping in, so some people are seeing some value at the dip level. And this is right, at least from the S&P at 3,600 range, is right around what a lot of people were talking about from a Fed put standpoint. That's where they would potentially back off a little bit. That would be enough of a retrace market-wise to justify it, but. No indications that they're making any alterations whatsoever. And of course, the euro is doing remarkably well given what we know and how things are proceeding. So there's been a lot of support that's been provided, and often we don't hear about that for many, many months later. That the Fed provided X trillions in liquidity and nobody knew about it. Same thing happened during the financial crisis. This is no surprise. Of course, we talked about it forever and sort of over it now, but TLT, that's Treasuries rising as it falls. And does it have more to go on? Probably limited, I think, in your downside here, simply because the realities for the Fed are going to come if they slow down a bit and wait for the actual economic trends um, to develop. They haven't been slowing down. I mean, this was the mistake that Bernanke made when he started raising rates to fight inflation early on and created the whole financial crisis by literally pricing people out of their own homes because of the adjustable rate mortgages and that existed. And you could see the same situation develop with credit. And that's how it all begins. And that's when the fractures start. And of course, you're already seeing the potential of corporate bonds being delayed in that. And these are the telltale signs, because that had not been an issue prior to this for a very long time. Um, and gold in that precept, you're caught between two worlds: this inflationary world, but also the potential for a deflationary setup with excess supply and inventories that are going to have to be liquidated. So you could have a short-term lull, but in general, gold will be going north, higher. Here it is from oil standpoint, right now just under that 90 a barrel status, but it was quite a run for a given week. And again, it just gets back to basic uh, supply and demand issues. I mean, you've got to have the supply. You can talk all you want about, this and that sanctions, but where in the world are you going to get the extra oil? And then, of course, OPEC cutting back, because, when a shark sees blood in the water, what do? They attack. Makes perfect sense. You can get upset at them all you want or whatever, but if the U.S. wanted to flip that around, they could turn on their capacity in a heartbeat, just as it was done a few years back, and prices would plummet. But no interest in doing that, that's the real question. I mean, so why not? You want to save the economy, that's how you do it. BTC still holding up quite well. Again, I think this has been a interesting thing. I mean, I've lampooned some of the crypto setups when they were at the excess values, and we could see from our readings that they were just not there. But we've now had enough time with Bitcoin in that, in a futures market as well as its regular, to start to gauge the degree of interest. And this has been a pretty significant support. So as long as it continues to hold it, and we're in a sell signal with it as it sits right here, but doing remarkably well within that. So it had traded tandem with the markets for a while, and then sort of bifurcated as some of the credit concerns started developing, which obviously they would be immune from, because it's not even the same construct. And then you go from an ETH standpoint, looking very similar. And from a 50K, after the decline, we started with this slow buildup, but weight's been leaning it relentlessly. But there's still been plenty of buyers to soak up any of that selling. So we could see white begin to downturn, and magenta cross back over it. The critical thing here is a pivot lower of magenta at this particular stage would be probably net catastrophic, at least a return back to the zero guaranteed, that 35.79 range. And from post market right here, we can see that we're getting some slight elevation after that pretty solid sell-off that took place later in the day, then started to build up as we ended into the close, came back at roughly halfway into it. Now we filled back a little bit further to where actually the breakdown took place. And again, it was another very nice day. We had some excellent range plays going in there, and then a bunch of muck at the higher levels where we were just oscillating back and forth. And that's where it gets a little bit tough. In that case, from my viewpoint, the ABM and those become helpful. And when you're not looking at any closes below the 76%, you're a pretty decent trend move from that standpoint. And then we could see earlier in the day it was much cleaner, things were much smoother. So in the pre-market, we had the fade right before the early open shot back up, only to regress right back into it. And so I think that some of those are just extremely clean and easy plays, and I think that this volatility is just right on par with exactly what we expected for the month. And I think with this uh, potential escalation of credit situation, you have to be watching closely, because we could see some dramatic events that are completely unrelated to uh, stock news and that, but develop in the bond market. Of course, it could be, that has ripple effects, and when corporations can't either refinance, get new funds, it starts to change the dynamic pretty quickly, and it starts a little bit. And you see these cracks. You have to pay attention to them because that's how the Lehman situation, the buildup was clean, and then boom, it just cracks, and then everyone's like surprised. Well, no need to be surprised. Anyway, you can look for me on Skype chat. Trade well. We'll talk to you later.